The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, boys and girls, on Federal Reserve Day, one of our favorite days of the year. We do have some increased volatility, but I was listening to Basil's show before I came on, and I heard him say that there are very few trend reversal days near Fed time, and I have to agree with that. I've looked at that also, and you just don't see that too often. If there's going to be a major trend change of any significance, I think it'll either come on Friday or Monday, because we have the full moon coming in on the 23rd, and that should be an interesting time. The last time we had one of these, we had a pretty good move in the market. But I want to start the show today. I posted two charts into Tiger TV. I posted the June S&P 500 because we have completed a ABCD Gartley. I'm also going to show the S&P 500 by itself, but I wanted to move from that particular area to the copper market, because I wanted to show you something that you're not going to see very often, and that is the divergence that's happened between copper and the stock market. I've been talking about this since January, and now it is getting extremely overbought, more than ever. In other words, stocks are overbought and copper is oversold. One of these two markets is probably trying to fake us out. Either people are not buying copper because they're not making products, or they're accumulating the copper at as low price as they can to build products in the future. Maybe that's what's happening. I could be totally wrong on this, but it looks like the stock market is the one that's wrong and the copper market is the one that's right. Copper is a market that could be manipulated, and whereas the stock market is could be manipulated for short periods of time, but not for long periods of time. That's the way I look at it. But this divergence that we've had since January is amazing. We had that rising wedge at that time when copper was $3.80 a bushel, $3.80 a pound, and now we're trading at $3.14 a pound, a full 30%, almost 30% lower than where we are now. So it has to ask yourself, why this has actually happened. Now, I would like to bring us up to date to something here. If you'll just give me 1 second here, I can do this without too much trouble. At least I'm saying that. Whether it happens that way or not, we'll wait and see. We have to talk about one market that we've been talking about for a great deal of time here, and we need to show that market to you folks, because we've had some really significant things happening to it, and that is going to be the corn market. We've had this really large move in corn here, coming off of this pattern that we were looking at the $5.25 a bushel level, and we've rallied well over 30 cents a bushel to the we got up to the 560 level, which was the 786. So we're ready for a little pullback in the corn market, but I think we have a potential to go a lot higher. I'll cover this in depth tomorrow. Hopefully we'll have Rich Anderson from Anderson Capital Management on the program, and we'll see if on the commodity show tomorrow, and we'll see if we can get him to tell us more about what's happening with corn, wheat, and beans, because it looks like it's ready to have a pretty substantial move, because this is what happened last year, almost to the day. Last year's bottom came on the 14th of June, and this year's bottom came on the 17th of June. So that's the main thing that we'll be watching here. This has been a good move, so let's move on to the next thing that we want to look at, and that is that stock market with the cash S&P. I wanted to show you that chart for a variety of reasons, and as the trading gods are trying to get me to do two things at once, which in my situation is not an easy thing to do. So we've got it set up now. But we have if you believe in patterns, boys and girls, we have a pattern forming in the S&P cash and also in the S&P June futures. However, the September futures are lagging very badly. They haven't even made the ABCD pattern. So somebody is either laying pretty heavily on the September futures, and that's what we're looking at. We for some reason, I'm having technical problem with the with getting my charts into Tiger TV, and I'll try to get that done, sometimes during the show, and we'll be able to see the charts. But I'm trying to show the S&P cash market, what we've done, over the past year, and it shows the trend line that we had since February. It's been going up. It stopped right at the 61% retracement 2 weeks ago in early June when we made the 61% retracement. And now the trading gods are either smiling or laughing at us because we are completing another perfect Gartley pattern right up where we are right now in the cash S&P. However, the June futures are lagging badly. They're about 6 points behind where they should be if they were trading where I misspoke that. I'm sorry. It's the September futures. We rolled over last week on last Thursday on the 13th. We rolled from the June to the September, and the Septembers are they are moving in a direction that is not equal to what's happening in the June market. So that's what we need to try to address, because I think that this divergence must mean something. But remember, this is a relatively small market, folks, compared to the bond market and compared to the other markets that we look at, like foreign currency and stuff like that. So I don't think that the reaction in stocks is going to be nearly as dramatic as it's going to be in the dollar, particularly in the euro and the pound, and possibly even the Japanese yen. So those are the one, and of course Treasury bonds and Treasury notes, because we're at such key levels in these particular instruments that if they don't hold that 138 level in the Treasury bonds, we're going to be looking at much higher rates. We already have higher rates. The question is how high they're going to go. This is what I think is the outlier event that the Fed doesn't going to have too much control over. I know they talk a great game, and so far that's been the way to go. But we'll see how the dice roll towards the end of the game here, because I think they've committed themselves to something that they're going to have a difficult time getting out of. History's going to tell this. It'll probably be 20, 30 years before we find out the reasonings behind it, and if in fact there are any. But I've seen such bearish patterns across the globe. It's just really pathetic. And now you're starting to see some riots in some key places like Turkey and Istanbul, and now Brazil. Brazil should be booming, and yet they're down there rioting and burning cars and looting buildings and stuff like that. And this should not be happening in a country that's going to have the Olympics in 2016. But whether that means anything economically and how long it'll last, is anybody's guess. We will have to see what that occurs. Now, I wanted to bring up the VIX index here, because we've been watching the VIX index. It's backed off very little from where we thought it was going to go. We did go up, and we made a ABCD pattern almost to that to the exact number at that 1850 level. And I believe that we're having such a slight pullback here that it looks to me like the VIX index is getting ready to take off again to the upside, because I believe we're going to see the VIX very shortly is going to be trading above 25, and that's what I'm looking at, because the pattern in the VIX index is very similar to what happened in the Nikkei Dow and also in the Japanese yen, when we had those three higher bottoms, and it kept trying to go higher and higher, and then finally broke out. And once it got above the previous highs, the month's high, which in the VIX index would be at 1920. If we take out 1920 in the VIX index, that would tell us that we'd be looking at the breakout to take it a great deal higher in the VIX index. There's still a lot of complacency, all across the street, in my opinion, because why shouldn't there be? You've got the NASDAQ, you've got the IWM, the Russell small cap, ready to make a butterfly top a little bit higher than where it is now. You've got the NASDAQ acting pretty good. So all of these things are telling us, that the market certainly wants to go higher. I've had several requests to revisit something that we've looked at in the past, and I'm going to bring that up here, and that is the chart of Apple. And all it's doing is trying to hide from me, and we're going to take a look at that right here. And we are getting ready in Apple to make a bullish Gartley pattern down about another $14 in the the price of Apple at $414 per share, and that is something that looks like that could happen within the next few days. I mean, believe me, this stock has been, going, the opposite of the market for some time now, and that's something that you have to remember, that it's a stock market, not a market for stocks, because each one of these stocks has to be looked at differently. The price of IBM and Google have to be looked at differently than Apple. We've already said that, because when Apple was 700. And everybody wanted it. All 33 analysts on the street were bullish, Apple at that time, and it left an island reversal up there around 703, I believe, and it came all the way down to the $394 per share level, which was our target. It went to $385, but we were looking at $394. It then rallied $80 during from April 22nd until the first week of May, and now we're completing another correction in Gartley format. So I would be looking, if you want to look at something to buy and you're bullish, I would be looking to buy Apple around that $415 per share level, and I would not risk more than about 4% on that, which would be around $16 or $20 per share. You have to risk that much in that stock because it's very volatile and it has a high capitalization at $400. You're not trading a $40 stock, you're trading a $400 stock. So that's what it looks like to me in Apple. If we took Apple on a slightly smaller time frame, if we go down and look at this on a smaller time frame of, say, an hourly chart, you'll see that we're coming into some support here at the I'm having technical difficulties, folks, with putting charts into Tiger TV, and that's my fault. It has nothing to do with TFNN. I'm just not familiar with the new software that I need to work with. But anyway, it tells us that we're very close, somewhere around this on the hourly chart, that we're probably will go a little bit below the last low, which would be equivalent to 415 on the daily. So that's the one we're looking at. On the hourly chart, we're very close to a bottom right now, but that's a shorter-term chart. We want to look at something a little longer. Okay, we got to take a little break here. 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. you take a hands-on approach to managing your investments. And whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX. The Art of Timing the Trade Charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade Charts allows you to scan for Fibonacci formation setups, including Gartleys, butterflies, ABCs, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, boys and girls, and we are looking at the chart for September Treasury bonds. We've just completed that major AB equals CD pattern down at the 137 and change level, and we've had a little bit of a rally. Now with the Fed coming in today, most probably what is going to happen, I've posted in there two scenarios to look at. The first one is the possibility that we've made the major bottom down there at 137, and we're getting ready to complete an ABCD pattern up at the 141.15 level. That's one scenario. That's 2 points from where we are now. And then we also have a scenario that if the Fed does something unusual, that we could go down and make a three-drive pattern down at the 137 level, which is, again, at that major support level on the long-term, weekly basis. So this is what I'm watching in the bonds, folks. The bond market looks pathetic. I've been talking about bearishness in bonds for well over a year. When we were up at 154, we're now down at the 140 level, and the bounces that we get. The last one we had in March, the bonds rallied $9,000. I would love to see a rally equal to that would take us up to about the 146 level, and I would certainly be ready to short Treasury bonds if we get to that level. What the charts are telling me on what the Fed is going to do today is that stocks are going to be down and bonds are going to be up. That's what the charts look like to me. Now, remember, I don't know diddly squat about what they're doing. The good news is not many other people do either. So all I'm going to be doing is reacting to what I see and what the Fed does. And it should be very, very active. The time between 2 and 3 o'clock is usually some of the wildest swings that we have. But that's good because, we are pattern recognition swing traders, and the market expands and contracts to these numbers that we look at. And if you can, do your homework and try to find spots, to look at certain things, that's what we want to be. That's what we want to be watching. When we come back after the break, of course, I am going to be talking about the euro and the U.S. dollar, and also the British pound, because we're at very, very important levels in the currencies, just like we were when the dollar index was 85. We've now come down in the dollar index to around 80, and that tells us that that correction should be over if, in fact, the dollar is getting ready to move, and I think that it is. The Treasury notes are also holding up incredibly well, and remember, the notes are about 3 times the volatility three times the volume and open interest that we have in the bonds. That's the 10-year note is the one that they use for interest rates and the one that they use for mortgages, and that's why it's so very important. The 30-year bond is the one that they use when they're calculating inflation rates and stuff like that. The Fed is deathly afraid of deflation. They're not afraid of inflation. They think a little inflation is a good thing. And if you want to believe that, just go look at the news some night this week and see what's happening with a little inflation that they're having in Brazil right now, because people are being taxed by this inflation, and that's the bad part of it. We have a couple of things that they tax us on. One is the price of oil, because price of oil is a hidden tax because everybody uses it, and as price of oil goes up, that's a tax that we have to bear. It's not called a tax, but that's in fact what it amounts to. It reduces our purchasing power, and that's what causes people to have problems. I don't know what's going to trigger this bearishness that I have in my bones, but all I can tell you is, boy, these charts look bad. I mean, I know they're rallying today and they look great and they've bounced back, but boy, when I look at these, I said, my gosh, this is mother God and country stuff. This is this is the kind of sell that you're waiting for, and whether that's going to be the case or not, we'll be able to see. I hope no one at the Fed is listening, but I'm just a little small potato, so nobody's going to listen to me anyway. But the charts are just incredibly bearish, and I'm just a chartist. I don't look at the fundamentals at all, and that's the primary thing that I keep in mind when I'm doing this, and it's served me okay. So I'll continue to do it until the final trading day comes, and hopefully that won't be for quite some time. When we get back, we got to take a little break here, but when we come back, I want to spend some time with the euro, because when I was on Monday, I talked about the euro at the 134 level, and we are there right now at the 134 level. We could go a little bit higher, but we'll wait and see. 877-927-6648.
Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short-term equity holdings, closing out all 4 positions for a combined 15.9% profit. And on April 1st, Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN. No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks. And before we get to the euro, I've had a request to go over the material that I talked about as the divergence between the cash S&P and the futures that we're looking at in September. And so what I did was I posted a chart of the E-mini S&P futures, the September contract, and then I've overlaid on that chart the S&P cash. In other words, it shows the comparison between the two, and they are pretty much the same instrument. The S&P cash is traded at the CBOE, and of course the CME has the futures for the E-mini. But they have to be the same because they're based on the same thing, so they'll come together on the triple witching hour. But when they're diverging like this, I think it means something, relatively important. And if you look, you can see when the high was made back on the 25th of May when we were having the lunar eclipse and full moon, the market in the futures made a new high, but the cash did in fact do not. And that's what we have happening now, is that we're having the cash, making the ABCD pattern, and the futures are lagging badly. Now, this could change in a matter of seconds, of course, at 2 o'clock when things are moving. But believe me, if you believe that somebody doesn't know what's going to happen ahead of time, you're being very naive, folks, because this is money that they're talking about, and money is power in Washington. And believe me, if they get a chance to move something, they are going to do it. I don't know what it's going to, how it's done or what's happened, but all I can tell you is how the human spirit works, and many people are, really in love with, the mother god of money, and they'll use it in any way that they can, and I'm sure that some of this does happen. It's never been proven. Well, you can see some of these guys are doing inside information, but government stuff, certainly does happen. I'll tell you a quick story here. This was one of my favorite stories when I was on the floor of the exchange during 1981 through 1983. During those 3 years, I saw almost everything happen. But there was a trader there who ran the cattle pit. His name was Harry Lawrence. His name was Harry the Hat because he always, wore these really fancy hats when he left the exchange. But he was probably one of the best brokers that ever lived. His brother was better than him. Ricky was far better as a broker, but Harry had a very colorful and sordid past and ended rather badly. But he actually had an account with Secretary of the Agriculture, Butts, and he was trading that account for him. And whenever there would be a hog report or a cattle report, you could just watch what Harry was doing. If he was in there buying, it was flat out going to be a bullish report, and if it was negative, it was going to be a bearish report. We saw this every single quarter during the 3 years I was there. I missed it the first quarter because I wasn't aware of what was going on, and then my good friend Byron Tucker, pointed it out to me, and for the 3 years I was there, it never changed. And anytime there was anything agriculturally related to the hogs and cattle, he had an insight of it. So I know somebody was telling him something because he was never wrong. And so these things do happen just because it's money, folks. It's not because people are bad. It's just that they believe money is more important than ethics, and that's just the way they live their lives. So, that's the way it goes. I have never had I've gotten stock tips before and other tips, but none of them have ever worked. I've never acted on any of them. So even when someone told me something was going to happen, it never worked. I cannot think of one time when someone told me, and I had years at Drexel for 5 years there, almost 6, where, I was pretty much on the inside because we were in Milken's building and we'd hear all kinds of things, and none of them ever happened. So, just do your own work, defy human nature, and do the work yourself, and I think you'll be far better off, and you don't have to depend on anyone. So that's what we're looking at. Okay, what we've got to do now is we have got something really serious happening here in the euro, whether it's going to turn out the way that we wanted it to or not, but we're going to take a look at it on a daily basis here, because we are at some serious spots here, and we are at such an outlier event in the, just give me a second to line it up to see it a little bit better, and I can put the ABCD pattern in so that everybody at Tiger TV will be able to, see the swings that we have happening now, because we're right at the little above the 61% retracement. We're right at the 707 level, which sometimes the euro will go to the 707. And there's a possibility after the report that we could even go all the way up another 80 pips to the 786 level at the 135 level. There's a possibility of that, but the pattern's completing. If you'll take some time to look at this euro chart, you'll see that over the past month, since May 20th, this has not had more than one down day with no significant swing that you can measure. In other words, it's not taken out the low of the previous day, but one time during that whole time, and that was done just on the 10th of June. It made a slightly lower low, and then it continued higher. So it's been up for 15 days, where it's made a higher high or higher close in 15 days. Now, the number of times that you see that on a chart, you can put on one hand. This is an outlier event that we're having. We have a situation where you had the ABC leg from March to May, and now you've had the situation now between May and June, and they're very, very close in time and price. We're 3 days beyond the time price in the euro, but I believe it's because of what the Fed is getting ready to do today. I'm not sure what that's going to be, but it should be a surprise, and it should be a negative surprise. So, watch your charts. Keep an eye on what the euro is doing, but there's a lot of resistance here between this where we are right now at this 134 level and where we are up at the 786, which would be at 135. That's a difference of 100 pips, which is quite a bit. And if it hits, it's probably going to give you several chances to be, to get short, in fact, if that's the way you want to do it. Now, this would be equivalent. If it gets above 135, that means that the U.S. dollar index would most probably break below the 80 level. That seems to be the mystery level in the dollar index, and that could possibly break below that. Whether that happens or not and stays there for any particular time, we will need to let history decide whether that's going to be the case or not. Now, if you want to look at the poor man's euro, which would be the British pound, we'll take a look at that, because you'll see that we are very, very close to the 61% retracement. Give me 1 second here to get the chart in properly so we can look at it, because we are very, very close to a perfect Gartley in the British pound, and that's about 100 pips higher than where we are now, and it's lagging the euro. Remember, when the euro started trading in 1999, before that it was the pound versus the dollar. That was the key. Everything was off the pound versus the dollar. When I first started trading commodities real heavily, in fact Forex back in 1972, before most people were looking at they had Forex banks, but very few people had access to them. The pound was at 550, and now it's at 150. That's how much it's gone down over the past 30 or 40 years. So that's a long-term trade. But anyway, that gives us an idea of what we're looking at. Now, if you take the same scenario and look at the Japanese yen, 35, 40 years ago was trading at 267 yen to the dollar, and it went down to 75 yen to the dollar. We're now at roughly 96 yen to the dollar. So that's how much the yen moved against the dollar. This is why Japan had so much trouble, is because the yen became so expensive, and they made the interest rates at zero, just like the Fed's doing now. And so all the person had to do was to sell the Japanese yen against, or borrow money in Japan at zero rates, and that made that the carry trade that they talked about, because you were letting the Japan carry the cost of the loan, and that made it good. Then you could take that money that you borrowed and invest it into commodities or stocks or whatever you wanted to do. Hopefully you did it on the right way, because if you didn't do it the right way, then you were in trouble. I did see an interesting documentary on 60 Minutes on Sunday about the Madoff fiasco that happened, and boy, oh boy, this went on for so many years, where the SEC knew about it and didn't do anything about it. It just shows you the comical nature of some of the things that can happen in government, that just because someone says that it's so doesn't necessarily mean that that's the way it's going to be. Now, the debate that they're going on with the Fed now is whether it's inflation or deflation. This we don't know for sure. Nobody does. But we've got a mixed situation going on. I'm going to do the gold and silver first, because those are the ones that, I trade gold almost every day, and I watch it very, very closely. But we've had a situation going back over the past month where, silver has been lagging gold by quite a bit. And gold made a little bit lower low yesterday, but it looks like these really want to go lower. That's the main thing that we're watching. And and then the second thing about the inflation is what's going to happen to crude oil. I'm going to cover that hopefully a little later today. If not, we'll do it on the commodity show tomorrow, because we have to look at gasoline futures, because gasoline here in Tucson, Arizona has now dropped well over 15% over the past month. We were at $3.65 a gallon, and now we're at $3.09 a gallon. So we've had a big drop, which is a tax decrease for us. But when we're looking at gold and silver, silver has made a higher bottom than we made back on June 10th. Gold made a lower bottom than we did on June 10th. That's a negative sign because gold is 6 times more, has more open interest and volume than the gold does. So this is one of the reasons why, gold is so much easier to trade. Your stops are triggered easily, your orders are filled better. With silver, there can be some massive slippage, especially if there's a big order, sitting there. Because silver is the poor man's gold. We'll wait and see if that's going to happen. Now, I want to bring up crude oil because we've had a request for it, looking at it on a little bit longer term basis. Let's do the longer term first, and then we'll go down to the smaller time frame. We've been watching the. I'll move it over so everybody can see it. Okay, if you give me 1 second, and I'll put it into the room, and I'll put this down. There we go. Okay, we have broken out to the upside in crude oil, and it means that we could be heading, above $100 per barrel. And when we have to stay above this 98 level for several days, and that's what we're doing. Now, because the Fed is in here, there's going to be some gyrations because crude oil moves pretty dramatically after the Fed. I don't know if you folks know this or not, but there are 6 major firms that do about 65% of all the business in crude oil in the futures exchange, both in West Texas crude and North Sea crude. Those firms, there's 3 of them in Singapore. There's one in London, one in one of the Scandinavian countries. It's either Norway or Sweden, and then there's one in New York. But those are the 6 major firms that that really do a lot of the trading. But fortunately, they trade right off the numbers and patterns, that we're looking at. And so we're if there's going to be in disinflation, in other words, deflation, crude oil is going to have to go down because when we had the deflation in 2007, crude was at 100 and I think the high was $143 a barrel, as I recall. Might have been $146, and then we went down to $30 a barrel, a drop of a better than 80%. So whether we're going to see something like that again, I'm not sure. I'm basing this on these long-term patterns that I'm seeing on the weeklies and monthlies in the stock market, and then also the Bradley model. The Bradley model starting to turn down also, so that gives an indication of where we are now. So that's what we're looking at as far as the crude oil. If we do get a more of a push through here on crude, there should be some really strong resistance up at that 101 per barrel level, and on the downside, there should be some strong support at the $93 per barrel level. The key to watch in crude oil is if we go back below $96 a barrel, that would be below where the breakout occurred. That means everybody that bought it on the breakout above 97 would now have a loss, and that could be, potential trap. Whether that is going to happen, we won't know for a few days, but there is a possibility of something like that happening. I had a request for a comment about Apple. I thought I covered that, but we'll cover it again. Apple should have some very strong support at $415 per share. That is a Gartley on the daily pattern. If you get Tom's new software that he and David have put together, The Art of the Charts, I'm sure that you're going to see Apple pop up on that particular program because it is a beautiful Gartley pattern that forms down at the 415 per share level, and if it holds that level, then it should have a very good rally. And but it's a lot. All I can tell you is this: it's a lot cheaper buying it at $415 a share than it was at $700 a share. Okay, we got to take a little break, folks. 877-927-6648.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and we have our friend from Philadelphia. John, are you there?
Good morning to you, Larry.
How are you, my friend? What can I do for you today?
I want to compliment you on that excellent purchase of December corn that I think you made Sunday night.
Don't confuse lucky with being smart. It just happened to work. A lot of them don't, but this was one that worked very well. So, but thank you. It did work well, and, you know, we hit our second profit objective today, and now we're looking for a little bit of a pullback to see if we can get re-entry in the corn.
Larry, I wanted to ask you on that these corn daily charts. If
Yes.
that 570 level, 570, which is about 10 cents over, current price. If that is taken out, I wanted to ask what you could envision as a price target, should that be the case.
Well, you'd be looking at probably 50 cents to $1 a bushel higher if you compared with what happened last year when we had the drought. Now, we're not having drought conditions this year. We're having a lot of rain through there, but rain can do as much damage as the sun can. So that's what I would be looking. I try to do, a couple days at a time to try to predict, a few months out. But above 570 a bushel, you're going to have a pretty substantial breakout, much like you had, in 2012. And the dates came in, within 2 days of each other, John. Last year it bottomed on the 14th. This year it bottomed on the 16th. So, they were spot on as far as the cycle goes, I think. So, but one thing for sure, John, if it goes below 527 now, you're going to be looking at 450 corn.
Indeed, Larry. Yeah. I will tell you, I find it just absolutely stunning myself. The cycles, the day on the calendar in June, where this year and last year corn bottomed the same day, and you are correct. I'll just elaborate on Mother Nature and weather. This year, the problem is too much rain. Much of the bean crop is not getting planted, and there's great confusion now how the crops will endure, and they're talking tremendous rains the next 5 days up in Iowa, which will presumably only compound this problem.
I agree. And folks, let me tell you something. This young man that we're talking to on the phone now, John from Philadelphia, really does his homework. He shares a lot of his information with me, and I trust the things that he sends me. And I'm hearing the same things, too, that we are getting, incredible rains through there. And, every time we have a crop coming in, we always have scares, whether they're, they turn out to be right or not. But you do get crop scares, and that's what, makes these markets so fun to trade because of the volatility. And, you don't really care as long as people get fed, where the prices are going to go. So it's going to be really interesting this year again. But frankly, what we had last year when corn rallied almost $10,000 a bushel, I don't know whether we're going to see that this year. Oh, we've got to go live every day in an attitude of gratitude, folks, and may God bless.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.